Hi and welcome back. I'm Steve Johnson, Chief Investment Officer here at Forager Funds. I'm joined by Alex Shevelev. Hey Alex, how are you?
Hi Steve.
Alex, it's been a really tough year for us on the Australian fund, unlike the international fund, which has performed very well. I asked Gareth in the previous video what his biggest lesson of 2020 was. It's an easier question to answer, I think, when everything's going well, but what would you answer to the same question across the Aussie fund in 2020?
Yeah. So we had a very difficult year, and a lot of that had to do with businesses that unfortunately had been performing badly for us in the prior year. Going into this year, we did quite a lot to change around the management teams of some of those businesses where we had reasonably large percentage investments, the boards of those businesses. There were in one of the positions, for example, was a merger with another business. But unfortunately, those directions can be hard to change and can be quite difficult to change over a short amount of time. We hope there's been quite a lot of work done there, and we hope to see the results of that work over the next year.
Yeah, these businesses that are not going well, where there's something wrong, with the management team hasn't been doing a great job. You know, we sat down last year and said we really need to change the direction of some of these things, and we've been able to do that over the years, but some of the problems that have been uncovered and the extent of the mismanagement prior has really left these businesses in quite a difficult position. And I think combined with a market that has no interest in a business that's not growing very rapidly, we've seen that turn up in very bad share price performance on the back of a year prior that had already been bad share price performance. In the performance report, I split up a bunch of the negative contributors into businesses that we've seen the economic backdrop, COVID-19's impact on the economy, have a very significant impact on the actual underlying business, and a group of them where the share price got absolutely pummeled, but we don't think the business has been badly affected. Which of that latter category do you think was the most significant in terms of share price overreaction to the underlying business reality?
So going into this period, we owned a position in Eclipse. Eclipse is a pretty major provider of leasing cars to companies. Now, that business is actually, at its core, quite a sustainable long-term business. Few competitors in that space. Is able to provide a platform and an ability for corporates to do something they would not have ordinarily been able to do themselves and at a better price. It has a real place in that market. Now, it went into the crisis a little bit too highly levered, and there were some concerns around their ability to sell used cars. But throughout this period, they've been able to sell used cars at the rate that they wanted. In fact, even above the first half of the year, most recently, they've been able to do it at spreads that are in line with what they were doing in the first half, which is a really positive move for that business. And there's been a new management team in there that's been trying to turn around this business. And they've actually done through this period a really great job of communicating with the market, but even more than that, being able to manage through a really difficult period. So we think it bodes well for this business in future as well.
Yeah, probably made 4 or 5 announcements here of we're okay, we're fine. No, we promise you we're really fine. Yeah. And behind all of that, the share price was all over the place. I mean, what was the magnitude of the share price movement here across the past 6 months?
Well, I mean, at a certain point, the share price there was down 70%. Now, now it's made up a fair amount of that decline, but it still remains below the levels at February.
Yeah, it's a business we bought prior to the crisis that we think actually has some medium to long-term prospects here, and that industry is ripe for further consolidation, and we're able to add a bit more to that investment at very low prices. We also added a number of new stocks across the period, or increased the weight of some of our investments quite dramatically. We've had this ambition over the past year, and I think it's been proven right, to try and add some higher quality, more liquid businesses to the portfolio and try and get that mix a little bit healthier between turnarounds and businesses that we think can grow and prosper over time. What's the one that you're most confident about that's a new addition to the portfolio?
So this is not exactly a new addition through this March period, but it did give us an opportunity to add quite substantially to this position. It's a business actually listed in New Zealand called Tourism Holdings. Now, that industry, this is rental of recreational vehicles and subsequent sale of those vehicles, it's gone through some really interesting changes over half a decade. And the business came into this with a little bit of an issue in its US business, but really core New Zealand, Australian businesses that were performing quite well. Unfortunately, we had COVID, we had the fires, then COVID. So a lot of the tourism issues have hit this business squarely, but it's actually managed through this period very well. So this morning I was on a call where the chairman of this business was speaking. He cautioned a lot of other companies that had rushed to raise equity very quickly and said, look, we had the ability to manage through this crisis. We've got a lot of RVs. We were able to sell them at pretty good prices in the US. We were able to reduce our debt load. When we need them back, we can buy them back and we can continue operating that business. So I think they get a big tick for managing through the crisis. They've put out guidance recently, which a lot of companies in the tourism space have been loath to do. So it's one that I think has managed through the crisis well, but also as it returns to a semblance of normal earnings, once you get a little bit of travel and a little bit of movement, that business can earn much higher levels of profit than it did before.
And how would you weigh up the potential for domestic tourism for that business versus international? Because it seems that we're going to get domestic recovery here much earlier than we get international. Where does that tourism-related business sit on that scale?
So a lot of the business here has been international previously. However, what we've actually seen, and it comes through, we actually write about this in the quarterly report, there's quite a lot of trips that Australians won't be taking internationally for quite a while here. And in fact, Australians make more trips internationally than we have incoming trips. So if you want a socially distant holiday, if you want to be out in the great outdoors, if you want to be reasonably close to home, don't want to get on an airplane, renting a recreational vehicle, going up or down the coast is going to be a pretty good holiday over the next little while. So we think that domestic part lifts quite substantially. Won't return the business to its full profitability, but it really helps to get it going.
Yeah, we're seeing that very, very strongly in the US, where it's summer over there. It's typically a summer holiday, and demand for recreational vehicles is sky high. I think that whole theme is probably going to play out here. It's been interesting, though, with motorcycle retailers and other businesses that you don't have to spend your money on a holiday. And I think some of that money people are saving, they will spend on domestic tourism, but also it may get spent elsewhere on other things that you might want to buy. And, you know, house upgrades and home furnishings and things like that are also doing very well. I think it's a really interesting business that's well run and has some good long-term growth prospects and the ability to navigate through this difficult environment probably fairly well, like the chairman said. Look, we recognise it's been 2 years of very, very poor performance from our Australian shares fund. We had thought we were making some pretty good progress leading into the first half results this year, and COVID-19 has certainly put a spanner in those works. But in some ways, it's also helped us accelerate the changes that we were making in terms of making this a better quality portfolio of businesses that we want to own for a long time to come here, and particularly the largest holdings in the fund. The underlying businesses have performed quite well, probably better than we had expected through this crisis. We know that over the next 12 months, we need to see that start turning up in some share price returns, and when we're sitting here next year, your expectations should be high about what we've delivered. Thanks for tuning in. We'll have the quarterly report and performance report out hopefully in the next week or so, so keep your eye out for those. Thank you.